And joining us now on the program is Thomas J. Hayes, Chairman and Managing Member, Great Hill Capital. Thomas, Doug mentioned it, and Tom just reported on it. Earnings will be a major focus coming up. I heard this morning that if you strip out Tesla, the Magnificent Six is expecting earnings up 30% year on year. The other 494, about 5%. What do you choose from?
Well, this is the reason that we see a lot of skepticism around this violent rotation that started about a week and a half ago, Brian. A lot of people think this is going to be a fake out, but actually what you're seeing is a deceleration. So if you thought that difference was big for this quarter, back in Q1, it was 50% earnings growth for the Magnificent Seven and negative 1% for the unmagnificent 493. And by the end of the year, fourth quarter, it's going to completely flip on its head. You're going to see 17% earnings growth for the Magnificent Seven and 19% for the unmagnificent 493. And that's why we think this rotation is real and it is durable because it's underpinned by earnings and Fed cuts coming to a theater near you.
Okay. So will that be amplified when we get the guidance from these big tech companies?
I think so. Look, they've had a tremendous amount of CapEx. They're all racing to hoard the GPU chips. And, you saw the article, the $600 billion question. Where are they going to get the revenues to support all the spend on GPUs that they've all been trying to hoard from NVIDIA and pull forward all of that demand? The revenues simply don't support it. So I think that's going to support the deceleration story, albeit there'll be great earnings and there'll be great earnings growth. It will just be at a lower pace while the rest of the market goes from negative earnings growth back into positive earnings growth. And so what we could see is the indices, market cap weighted like S&P 500, more subdued because the heaviest weights will be consolidating. While under the surface, there'll be tremendous opportunities to make money.
Yeah, so it'll look like an average day, but you actually made money. However, your thesis, while I love it, if it turns out to be true, it's quite dependent, don't you think, on growth holding up?
It is. There's no question about it. I mean, even if you look deeply under the surface at small cap earnings growth, which have had really not strong earnings growth, 4.1% expected for this year. That's going to accelerate up to 17.7% next year. So that is a sign of growth. And the underpinning of this that not a lot of people are talking about, Brian and Doug, is the destocking cycle is about over. For many companies, you've heard in the last 1, 2, 3 quarters, that's done. And the restocking cycle and the CapEx cycle is just picking up. And then you have all the reshoring to support it. And manufacturing, which has been in a clear recession for over 2 years, is now starting to show signs of buoyancy. So all of these things under the surface point to healthier markets, not just controlled by a handful of stocks like we saw in the first half. 5 stocks generated 60% of the S&P returns.
So when I hear that, then I'm wondering, why should the Fed be aggressive in cutting interest rates?
Well, you do have slowing in the labor force, which is problematic. The key here is if you let it go too long, it becomes too costly to fix. So we're of the view that if they move in September, as the market consensus is pointing to 98 or 100%, depending on the day you look at it, chance of a cut. It may be more of a mid-cycle soft landing where 1 or 2 cuts could be sufficient, maybe 3 cuts. If they let it go much past that, I think the acceleration in the softening in the labor market and the deceleration now that we're seeing some of the auto insurance come down, owner's equivalent rent start to catch up on a lag basis. Inflation is a much easier problem to solve than deflation. Deflation is costly. It's long lasting. It hurts a lot of people. Inflation, if they move too early, they could always hike again. I know they don't want to do that. And I think the probability of that is extremely low. Hike early. You won't have to hike as much. And let's keep things on steady footing.
Now, we know what happens when too many people load up on one side of the boat. At some point, they have to rush to the other side, and it really causes a lot of sloshing around. You say the 4 most crowded trades are long the Magnificent Seven, short yen, short China, and short small caps. So would you flip all of those on their head And we'll see how bold you are if you're ready to short the Magnificent Seven.
Well, I wouldn't short the Magnificent Seven, but I do think what's going to happen is they're going to underperform relative to the unmagnificent 493 that are just catching a bid finally because their earnings growth is starting to support that bid. So I think you're going to see some underperformance in those crowded trades. Some of them will probably cool off, but on balance, maybe consolidate performance for 4 to 6 to 9 months.
Which of those four look best to attack? Would you say maybe it's shorting small caps, that's a good one to flip?
Oh, 100%. You want to be long small caps for the next 6 to 12 months. And history supports that out. After the first Fed cut over the next 12 months, small caps outperformed large caps since World War II by about 11%. So history is on your side with long small cap. I think China equities, we didn't get the boom we wanted out of the third plenum. However, we got the surprise cut this morning. I think more to come on the property front, and the valuations are simply too cheap. It's been a long wait for a year and a half, dead money. The market's been going sideways. You're seeing some smart money selectively start to filter into highest quality China equities. Mm-hmm. I think small caps is an easier trade. And then short yen, you're going to see potentially some intervention. And with the Feds starting to weaken on a relative basis, I wouldn't be short yen in the hole here either, to be honest with you.
So maybe I'm going to be short the dollar, particularly if, the Fed is going to cut, in your view, maybe as many as 3 times. And if there's going to be a bit of short covering in yen because of it being a very crowded trade, and at some point the BOJ is going to move and tighten conditions in Japan, is it wise to be short the dollar at this point?
Well, I think you're right, and I wouldn't play it explicitly through short dollar, but I would play it through what benefits from a weakening dollar. You're correct on direction, but what's the best way to express it? We like international stocks, which have underperformed relative to U.S. stocks. And then as it relates to rate cuts, we like small caps will benefit, cyclicals will benefit, and REITs will benefit, interest rate sensitive. So I think the biggest way to play the weakening dollar over time is going to be to have some international equity exposure, which really, if you're biased by recency bias, where international has just underperformed for so long, if you zoom out for the last 50 years, you've had some meaningful periods of outperformance, and I think we're right on the cusp of one right now. The band has been stretched to such an extreme level, it might be time to take action.
All right, I got $1 million to invest. Give me your number one unassailable back up the truck bet.
Oh my goodness, this is tough. We run a concentrated portfolio. I can't give you one, but I'll give you a couple of the names that I feel very confident about because we can't predict which ones are going to pop first, but we know if we use a reliable framework and buy quality when it's on sale over time, we're going to get full value. The
quickly, first one, Thomas, quickly.
We like Disney. Okay, that's undervalued. You're basically paying for the parks and consumer products and getting the TV, the theatrical, and Disney Plus for free. We think that can go from 94 to 150 plus over the next few years. And GXO Logistics, there was a pull forward on products, then to services. Now it's becoming more balanced. Their business is going to come back.